Hi, everyone, and welcome back to part 2 of our discussion on Chapter 3. So now we're going to continue looking at the common financial ratios used to assess the financial health of a company. We've already looked through some short-term solvency or liquidity ratios, the current ratio, the quick ratio, the cash ratio, net working capital to total assets, and interval measure. We looked at long-term solvency measures, which will help determine how well the company could pay its long-term debts, how much of their assets are being financed by debt versus equity. And we looked at the total debt ratio, debt to equity ratio, the equity multiplier, and the long-term debt ratio. We're going to continue with those solvency measures, and now we're going to focus on the interest portion. So those first few ratios focus more on the principal or the actual debt that was taken. Now we're going to look at, well, let's see how well we could pay our interest. And these ratios provide that information. So times interest earned is where you take earnings before interest and taxes and divide it by interest. So if we go to our income statement from that previous slide, earnings before interest and taxes are $1,138. So we take 1,138 and we divide it by our actual interest expense we had for this time period, and that was 7. And you could see that back at your income statement. So what this is saying is that this company is able to pay their interest almost 163 times from their earnings before any interest or taxes. Now, are they going to pay it that many times? No, but the more times they can, the more likely they can cover it with the earnings, because that's where they're getting the money to pay for the interest, the earnings. Cash coverage also measures interest, but it's just looking at the amount of cash from earnings. So now we're taking earnings before interest and taxes, add back the depreciation that is a non-cash item that was subtracted from as an expense. And that'll give us more of the cash component of earnings before paying interest and taxes. Divide that by the interest amount. So you would get those numbers there. Again, the earnings before interest and taxes, 1,138. The amount of depreciation, I'll go back over to the income statement here. Right here, the amount of depreciation is 116. There's our interest expense. And we complete the calculation. So we're able to pay interest from the cash component of earnings 179 times. And when I say I mean the company, of course. So this is showing how well the company can handle the interest portion of long-term debt. Now, again, is that good or bad? I mean, to me, you look at it and go 163 times, that's pretty good, right? But what was it in the past for this company? What is that a ratio like for others in our industry? That's how we truly assess how well we're doing. Remember, and I should have brought this up a little bit ago, but let's just talk about it now before we move into our asset management ratios. And just like when your doctor takes your blood pressure, okay, you go to the doctor, they use some tools to assess your health, right? Your heart rate, your blood pressure, maybe your temperature. The blood pressure for someone in their 20s, okay, maybe the normal, I should say, the normal for somebody in their 20s is different than the normal for somebody my age in my 50s. So when we calculate ratios, we get a number and we know what they tell us. But to assess if it's strong or weak, just like what they do with your blood pressure, They say, what's the normal range for a 20-year-old? Somebody in your peer group. What's the normal range for someone in their 50s? Okay. And even then, they still stop and go, well, what's your past history like? So we do that the same with companies. We just want to make sure we keep that in mind, because we just don't want to automatically say, wow, they're doing great. We're not sure. Just like when you get your blood pressure, that number doesn't mean anything unless you have a benchmark to compare it to. Okay, so now we're moving into our ratios that determine how well we manage the major assets of the company, inventory and accounts receivable being the two major ones. And we measure them by what we call the inventory ratio, which is our first ratio. And what we do is we take the cost of goods sold amount from the income statement and divide it by our inventory balance from our balance sheet. So I'm just going to fly on over to the income statement, cost of goods sold, 2006, go back, inventory, 501. And the calculation gives us a 4.0 times. And what does that mean? Well, think of that word turnover. When you might have heard it as employee turnover. So that's how many times we have to replace an employee. That means the same thing here. So 4.0 times is telling the company you've replaced inventory on average 4 times during the year. So you can look at it from you sold out of inventory 4 times during the year on average, or you had to buy inventory 4 times on average. Okay, so that's what it's telling us. I love this next ratio because now it converts it into something more meaningful for me. Days sales in inventory. There's 365 days in a year. So 365 is your top number, your numerator, divided by your inventory turnover you just calculated. So how many days does it take on average to sell an inventory item? 91 days or 3 months. So this is giving me more great information. So it takes us about 91 days to sell an inventory item from the day we buy it to the day of sale. So this is telling us how well we are managing our inventory. We probably have benchmarks we want to compare that to. What does everybody else in our industry do? But that's what it's telling us. We have the same type of calculation for accounts receivables. Remember, our focus on accounts receivables is collecting it. Our focus on inventory is selling it, because if we're not selling it, we're not making profit. If we're not collecting receivables, we're not getting the cash. So we want to make sure we're collecting them the way we're supposed to. So how we calculate receivables turnover is the sales from the income statement divided by accounts receivable. So let's go ahead on over. Income statement, 5,000 in revenue. And then our balance sheet, accounts receivable, 1,156. So when we divide the sales by the accounts receivable balance, now we're getting 4.33 times. That's telling us how many times on average we collect our accounts receivable balance for this year. 4.33 times. So we'll compare that to our benchmarks in our industry. Days sales in receivables, this is my number. I like this because this is telling us how many days it takes us to collect our accounts receivable, what a customer owes us, from the day we make the sale to the day we collect the money. So if you take 365 days and divide it by that receivable turnover we just calculated, it takes this company 84 days on average, that's almost 3 months, to collect their money from the date of the sale to the date they actually get the cash. Now, that doesn't mean everybody pays that way. It's just giving you an average. Some people may pay quicker, some may take longer. Okay, but the average is helping us, and that's going to help us manage our working capital as well, because that's telling us, where's our cash at? How long does it take us to get our cash? And in cash management, we use that, and net working capital management, we use that to predict and determine when we're going to have money. Do we have to borrow money to cover our bills because that money's not going to be here? So it's a very important ratio, not only to determine how well we're managing it, but also to use it in the actual management of these types of items. Our next ratio that helps us determine how well we are using and managing our assets is total asset turnover. Total asset turnover is found by taking your sales divided by the total asset amount. So it's telling us how much sales, dollar-wise, we're making on the dollar amount of our total assets. So it gives us a little pause there, because if you look at this, our sales were 5,000. We already know that. But if we go to our balance sheet, total assets are 5,606. So it looks like 0.89. We're not even making $1 of sales. We're only making 89 cents of sales on the value of the total assets in our accounting records. But it says this is pretty common, especially if you have a lot in fixed assets. So those long-term assets. Okay, so again, how well are we producing sales with our assets? Look at benchmarks. Net working capital turnover. Sales divided by net working capital. Excuse me. So if we take our sales, 5,000, take our current asset total minus our current liability total, divide that net, that's the net working capital we have, into the sales amount, we get 28.9%. So this is showing us how much, quote, work we get out of our working capital. So that working capital, how much in sales is it producing? It produces sales 28.9 times. Then we have fixed asset turnover. How well are we using our fixed assets to produce sales? So the value of our fixed assets, we're able to produce sales 1.45 times. So if you're going, well, what does that really tell us? Well, you got to compare yourselves. How are other companies using their fixed assets to produce sales? This company is able to take the value of their fixed assets and produce sales 1.45 times of that value. They do that 28.9 times with their net working capital value. So it's just determining how well we're actually using these assets by how much we produce in sales. Okay, so how well we're using the assets, how well we're managing them. Are we producing sales with them? So these 6 or 7 ratios help us define that. The next set of ratios measures how profitable we are. The first one is profit margin. Net income divided by sales. So if we go back to our income statement, net income is $893, sales are $5,000, 17.86%. So it's saying we're keeping, for every dollar of sales, we keep as profit 17 cents or almost 18 cents, 17.86% of it. So what does that mean? Well, some of it may go to the owners, or some of it we may keep in the business. This is a very important profitability ratio, and it varies significantly from industries. Trucking, and when I worked in trucking, it was 8%. That was a great profit ratio. When I worked in broadcasting, it was 30%. So that really does vary depending on the industry that your business is in. Return on assets is where we take our net income and divide it by total assets. Now remember, total assets are the value of everything you're using. That's the total investment from the creditors and the owners. you use the investments they give the company to purchase assets. How much money is the company making by using those assets? That's net income. So if we want to convert that to a percentage, you could look at it as if total assets was the total amount in my savings account, net income would be the interest you made on your savings account. So you would be earning a 15.93% interest rate. And that's what they're measuring here and telling owners and creditors, we're using your money and we're able to make a 15.93% return to you or to the company overall by using those assets. Now, return on assets measures the return to all investors. The next ratio just focuses on those who are owners of the company. So how much money is the company making, net income, just from the investments from the owners, total equity? So I didn't go back over, but let's take a look. Our income statement, we know we have $893 in net income, but if we go to our balance sheet, common stock is that's our total equity here, is $2668. So if we divide net income, the amount of money the company made, from the investment by the owners of $2768, their return is 32.26%. Now, it doesn't mean they're getting that in cash. It's just saying how profitable the company is when they're using the owner's equity to make net income. So the first one says, here's the return to everybody, creditors and or the owner's equity. And the second one just focuses on the return to the owners. So that is how we determine profitability of the company, using those investors' money, how well they produce a profit, the company produces a profit, and how much of the sales are left over as profit, so how they're managing those expenses. The next measures are market value measures, and that's usually of the stock. So in here, the very first item is the market value itself. So we're assuming here the company's market price, the day we're doing these ratios, or the day the balance sheet for the ratios, is $87.65 per share. The number of shares of stock the corporation has sold and are outstanding are 190.9 million. Now, the very first ratio, and it's not on here, that you need to be familiar with is earnings per share. Now, usually, earnings per share is listed directly on an income statement. We don't need to calculate it. It's actually required by GAAP that we include that on the income statement for decision makers because it's the most used ratio and most common ratio that investors look at. And what does it tell us? It tells us how much income, net income, the company made for one common share of stock. So in your book on page 66, they show you that. Net income divided by shares outstanding. So if we took 87.65, no, I'm sorry, net income. It wouldn't be the 87.65, right? It would be the, let me go back to it. I don't have it. I think it was the 863. And divide that by 109.9. Okay, I think I'm off a little bit. Let me see if I can go back. I'm going to go back to the income statement. 893 was the net income divided by 190.9. I get 468. And that's where they get that denominator there of earnings per share of $4.68. So this is telling a shareholder, if you own one share of stock, this is how much earnings the company made for that one share of stock. Doesn't mean you're going to get all of it, but that if you looked at it from the perspective, if they declared all net income as a dividend from this year, how much would I get? $4.68 for one share. That would be your dividend amount. Okay, so let me go back to that. And there it is. I thought it was on here. So the company in your presentation here shows you they already calculated that. Okay, so I'm going to go back to all right. Now, the next ratio is the price earnings ratio. So this is telling you how much an investor values $1 of earnings per share. So we calculate it by taking the price, the market price of the stock, $87.65, and dividing it by earnings per share. So that's 18.73 times. And just to wrap your head around this, what that means is, let's say the company came out and said, we're going to make $3.68. We predict our earnings per share is going to be $3.68. And the actual is $4.68. So it's actually $1 more. The market will react to that. So the buyers and sellers of stock will react to that. So there's actually $1 more in earnings per share than what they once predicted. At this time then, theoretically, the market price of that stock should increase $18.73. That's how you can look at that ratio. Okay, so that's how much value $1 of earnings per share has to the average buyer of this stock on this day. That changes. The market to book ratio, we take market value of the stock divided by book value of the stock. Book value, remember, is the value of the balance sheet. So let's go back to the balance sheet. Right now, the common stock's book value is at $27.68. So that's how much the company received in investments and has in earnings. I'm going to go back, sorry. So what they're saying is okay, let's convert that to a per share amount. So we have $27.68 in book value divided by 190.9 shares. So when you do that, the book value per share of stock would be $14.50. In the market, it's $87.65. Divide that by $14.50. So the market is 6.04 times the book value. Okay, so again, we're going to compare ourselves. What are other people's market to book ratio? And that will determine information about our market value. Enterprise value. Enterprise value is an estimate, I'm reading this out of the book on page 67, an estimate of the market value of the company's operating assets. Okay, so what kind of value is there really in the operating assets of the company? And how we determine this is we take the market value of the stock plus the book value of the liabilities minus cash. So how do they get that market value? Well, let's go back to this previous slide. 87.65 times 190.9, the number of shares, 16,732. The book value of the liabilities comes from the balance sheet. I'm going to go back there. Just bear with me while I get there. There we go. The book value of the liabilities is 1995, the current liabilities plus the long-term liabilities, or 28,638. And then the cash balance on the balance sheet was 108. So the market values this company, okay, the number of shares times the market value. So the total value of the company, equity-wise, is $16,732. We add the book value of the liabilities, which usually isn't that far off from market. Okay. So that is the total really of, quote, the market value of the assets, right? Of the assets, liabilities plus equity. Subtract out the cash portion because we're determining operating assets. We don't want cash involved in that. So the value, the total enterprise value, the value of those operating assets right now in the market is $19,462. Now, so this is measuring market value of those operating assets. Earnings before interest and taxes, depreciation and amortization ratio. We take the enterprise value and we divide that by, so it's really saying how well we use the assets at market value, enterprise value, those operating assets to produce earnings before interest, taxes, and the depreciation and amortization. We ignore those. So we take that enterprise value we just calculated and divide it by, go to your income statement and get earnings before interest and taxes, and then add the depreciation back, because we want to ignore that. And in market value, you wouldn't record depreciation. So we divide that total in the denominator into the market value. So how well do we use the market value of the assets to produce earnings before interest and taxes? We're able to produce, using that, 15.52 times. Okay, so it's just another measure of how well we're using the assets. So we wanted to show you these in detail and explain them so that you understand they're very important in finance and determining the financial health of the company. Now, the next area is the DuPont Identity. And I'm just looking here. And they run through in your book an analysis using DuPont, but more importantly, what this DuPont identity is. And it's really a combination of ratios. First, how we calculate or determine this DuPont identity is we take return on equity. We already saw the return on equity ratio. You take net income divided by total equity. So that's telling you how well the company is using the money of the investors to produce net income. We would then multiply by 1, or total assets over total assets. When we do that, we take the return on equity, net income over total equity, times total assets over total assets. What does that give us? It gives us net income over total assets and total assets over total equity. Or now we have return on assets, times times the equity multiplier. Remember, that's how we got our equity multiplier, total assets over total equity. Multiply by sales over sales, and then rearrange it. So now we're going to take return on equity equals net income over total assets over total equity, or the equity multiplier, times sales over sales. So now we're going to have net income over sales times sales over total assets over total equity. So now, just converting each of those to the real ratio they are, what is return on equity? Profit margin times total asset turnover times equity multiplier. So we're just showing you how we can convert return on equity using these other items and change it from net income over total equity to profit margin times total asset turnover times the equity multiplier. So that's what the DuPont Identity tells us. It's really these three things that make up return on equity. How do we use it? Well, now, remember, profit margin is a measure of the firm's operating efficiency. So how well it controls costs or expenses. Total asset turnover is how well the company uses the assets. How well does it manage its assets? The equity multiplier is a measure of the firm's financial leverage. So if we take, and this is using Yahoo and Alphabet, it looks like, two different companies, and we use their profit margin times their total asset turnover times their equity multiplier, then we can calculate their return on equity. And you can see Yahoo's varies quite a lot from Alphabet. So it's a different approach to calculating your return on equity. I love this, the DuPont chart. So now we see how all of these ratios are related. So return on equity would start is return on assets times the equity multiplier. Okay, return on assets is the profit margin multiplied by the total asset turnover. What's total asset turnover? Sales divided by total assets. What's total assets? Fixed assets plus current assets. Current assets, we have cash, accounts receivable, and inventory. So it all can be charted out. Return on assets, again, would then be your profit margin times total asset turnover, but what's profit margin? So, I'm sorry, the right side, we're focused on the balance sheet, some of the income statement, but on the left side, we're more focused on the income statement items. So profit margin is net income divided by sales. What's net income? Sales minus costs. What are the costs? And there are those amounts. So we could flowchart this so that these ratios also make more sense to us using the DuPont method. So why even do this? Well, we said internally, we want to see how well we're doing. And we use it for compensation purposes and to compare against other divisions and for planning in the future, estimating future cash flows. I pointed out a couple situations where I said, yeah, when I was a cash manager at WNEP and at the trucking company, I used my day sales in receivables to predict the future. I use profit margin every month. We used it for planning in the future. Especially at WNEP, I use that all the time. My bonuses were based on some of these ratios, especially the day sales and receivables. So internally, we use them a lot because we want to assess our own health. But externally, creditors will use, especially banks are going to focus on these if you want to borrow money from them. Sometimes they make sure while you borrow money, your ratios stay at a certain level. Suppliers want to know, customers, and especially the stockholders. Now, different external users may focus on different types of ratios, but they're all using them. As I said, how are these ratios used? To really assess and from the analysis side, we know what they mean. But from the actual conclusion, how do we know? And that depends on a couple different comparisons. We can compare ourselves to ourselves. We call that time trend analysis. So we look at our performance over time to determine how well we're doing. And this will also be used by internal and external sources. Peer group analysis. I already talked about this. We want to compare ourselves to similar companies or our whole industry. And we do that through our coding system. There are companies, Risk Management Associates is one of them. I actually bought their book probably 10 years ago. Now everything's online, but it costs money. But companies gather information about companies and industries. And let's say you're in the trucking industry. They're going to gather financial statements from trucking companies, good and bad. They're going to compute the ratios for each one of these companies and then average them together. And that's your peer group average. So you can see, how well am I doing compared to my peers, the other companies in my industry? Or maybe you'll find a similar company that's a lot like you that you just want to compare yourself to. Or external or external users will do that. They're very important for that purpose. This is how we determine how well we're doing. So again, people always ask, which is the most important ratios? Well, there's no way to know which ratios are most relevant. Okay, so these are potential problems with it. Oh, by the way, page 76 and 77, this is the RMA example pages. So this is what you would see. I'm not sure who this is for, what industry, manufacturing, wineries. Oh, okay. So if you're a winery, you make wine, you want to see, look at that vertical analysis there right next to the assets. And it tells you by the amount, I believe that's sales. So if your sales are between $0 and $1 million, there's the ratios you should use in that first column. If they're between $1 and $3 million, and they're telling you how many companies they've gathered information on in each of those categories. And then it would carry over to the next page with some common financial ratios. These are the industry averages. At the top of the page, on page 77, they're telling you about what type of auditing. So some companies are audited. You could see unqualified report means that they pass their audit. Some financial statements are called what we call reviewed. They're not audited, but they're looked at. That's why you can look at them. And some are just compiled, which means the company just takes and an accountant just produces financial statements for them. They don't look at them in detail, the numbers, or they're not giving assurance that the numbers are 100% correct. They're just taking the numbers and creating a financial statement. They're not audited at all or even looked at in detail. So they're telling you the number of types of financial statements that were being looked at here. What category were they in? Because that's going to determine how much you could rely on the information. So the more audited financial statements used, the better the ratios. So if you have any questions about that, please let me know. And then it continues to page 78 with more ratios. And again, that's being divided up by the amount of sales each company has. Benchmarking is difficult for diversified firms, so that you know that, okay? Another thing is that in the United States, we use United States accounting rules, and the rest of the world is using international accounting rules. So if most of your competitors are in an international market using international accounting rules, it may be hard to calculate these ratios because they're using different types of rules to determine net income and the balance sheet items. It's also a drawback if most companies in your industry are using one type of accounting procedure and you're using another. Like they give an example, FIFO and LIFO. So your inventory comparisons are going to be different there. Same with if you use straight line and everybody else is using double declining balance. So that causes some problems with financial statement and using those peer groups. If you have different years, so let's say your year ends your accounting year ends June 30th, but others in your industry, theirs ends December 31st. So they're basing their ratios on December 31st, 2018, but you can't calculate yours till June 30th, 2019. So there could have been, because of timing, effects on the ratios. So if you're looking at companies with different year ends, that could cause a problem with your ratio analysis. And then extraordinary events, things that happen that disrupt your financial statements in a year. You have an earthquake. We saw this a lot with 9/11 happening. The effects on businesses in that area because of that event. So sometimes we have to really take and step back from financial statement analysis and say, geez, did anything really unique happen that would affect this company's financial statements in a negative way or a positive way, that if that event didn't happen, they would have been normal. So you can't take that year as a norm because something crazy happened. I'll give you an example. When I worked at WNEP, I started working there in July of 2000. And that year there was a presidential election. And Northeast PA was considered ground zero for the determination of who would win the presidential election. Of course, we know that wasn't true. It was Florida, but at the time, that's what they thought. So both political parties were infusing money into our television markets and our advertising. At that year, I doubled my budget. So the net income that was predicted, say it was $50,000, just because of that extraordinary event occurring, my net income for the year ended up being $100,000. Well, that's not normal. So you need to take these kind of things into account when you are analyzing financial statements, and that could cause a drawback if you're not thinking in those terms. Okay, so those are some of the areas that we want to be mindful of when we are completing financial statement analysis and comparing ourselves to our peers. So the internet could help you a lot with doing financial statement ratios. Okay, you can go to Reuters' website, click on markets, then stocks, then choose a company and enter its ticker symbol, click on the financials, and you could see what kind of ratios are even available for them. I might try that in a second here. There's a quick quiz. And then there's some questions here on ethics. Should financial analysts be held liable for their opinions? How closely should ratings agencies work with the firms they are reviewing? So these are good ethical issues. Is a rating agency that says, hey, this company's a great investment, or you should invest in their bonds. If they work closely with that firm, are they really giving an unbiased opinion? Should they be independent totally from that company? Great ethical issues here that need to be addressed to be sure that the people in the markets are getting great information. One last comprehensive problem. XYZ Corporation has the following financial information for the previous years. They have sales, profit margin, current assets, fixed assets, net working capital, and long-term debt. What's their ROE using the DuPont analysis? So you just need that information. Let me go back. Okay, so if you go to your DuPont analysis, and this was on the identity, on page 70, if you know the profit margin is 0.08, it looks like we have to calculate total asset turnover, and we will have to calculate the equity multiplier. So now you want to go back to that total asset turnover, which is on page 64. Remember, that's where you take sales over total assets. So sales here are 8 million. Total assets will be the 2 million plus the 6 million. That's 8 million as well. Okay, so that'll be 1. Then multiply that by the equity multiplier, which was back on page 61. That's total assets divided by total equity. Total assets again are 8 million. Total equity we'll have to calculate. So that would be your current assets plus your fixed assets, 8 million, minus 3 million, or 5. So 8 divided by 5 will give us an equity multiplier of 1.6. So if we take our 0.08 times 1 times 1.6, looks like our return on equity is 12.8%. Okay, so that is how we determine the ROE using the DuPont analysis. Just want to make sure, net working capital. Oops, sorry, I did something wrong. Forgot about current liabilities. So let's step back here a second. So when we're doing our equity multiplier, the total assets are 8, but our total equity will be current assets plus fixed assets. That's still 8. Net working capital is 1 million. Remember how we get net working capital? Current assets of 2 minus current liabilities. So if our net working capital is 1, our current liabilities are 1. So to get equity, we have to take the 8 million in total assets minus the 1 in current liabilities minus the 3 in long-term debt. Sorry about that. So 8 minus 4. So it's 8 divided by 4. Our equity multiplier is 2. So now take profit margin, 0.08. Total asset turnover is 1. So times 1, and then times 2, will give us 16% return on equity because our equity multiplier is 2. Sorry about that. So that should be your answer for your comprehensive problem. Okay, so I know lots of stuff in this chapter. Hopefully I've given you some good information here that you're going to be able to complete financial statement analysis and understand why it's important and some of the problems that could occur when you are actually doing financial statement analysis. So please post any questions you may have to the discussion board.